Okay. Hello, 25 January 2025. Weekly Marx at theautonomouscollective.net. Tomorrow, we'll probably do the next chapter in the 2024 edition translation of Marx's Volume 1, and the done by the two Pauls. But today, I wanted to return to surplus value and how we might measure difference. What kind of precision are we trying to get? Why is it that there is no specific accounting measure, capitalist accounting measure for surplus value, although some things can be used? And in fact, it would be, I think, I'm not sure that there's a literature that addresses it specifically, but I think it's worth talking about. Although I think for some people, to try and create a capitalist translation of surplus value is always a dicey matter. Let's put it that way. For all the usual reasons, it doesn't represent labor accurately. You're undermining the working class. Blah 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 blah. Um, Empirical measures still need to be made, and the measuring of those kinds of things is problematic for a variety of reasons, some of which make sense, some not quite, but and some may not need to be made at all, which is part of I think, the history of the discourse on this matter. Anyway, let's get to it. In the Wikipedia version, in Marxian economics, surplus value is the difference between the amount raised through a sale of the product and the amount it costs to manufacture it. That is, the amount raised through the sale of the product plus the cost of the materials, plant, and labor power. Now, the concept originated in Ricardian socialism, with the term surplus value itself being coined by William Thompson in 1824. However, needless to say, 1824 and another 50 some odd years, and stuff still doesn't get squared away. However, it was not consistently distinguished from the related concepts of surplus labor and surplus product. The concept was subsequently developed and popularized by Karl Marx. Marx's formulation is the standard sense and the primary basis for further developments. Though how much of Marx's concept is original and distinct from the Ricardian concept is disputed, and there's a whole bunch of business on that. And of course, it gets weirder, Steedman et al. Marx's term is the German word Mehrwert, which means value added. That is sales revenue plus the costs of materials used up, and is a cognate to English more worth, which isn't necessarily wealth, right? So that's which in fact would be a different thing from an accounting point of view. It is a major concept in Karl Marx's Critique of Political Economy. Conventionally, value added is equal to the sum of gross wage income and gross profit income. However, Marx uses the term Mehrwert to describe the yield, profit, or return on production capital invested, i.e., the amount of the increase in the value of capital. Hence, Marx's use of Mehrwert has always been translated as surplus value, distinguishing it from value added. According to Marx's theory, surplus value is equal to the new value created by workers in excess of their own labor cost, which is appropriated by the capitalist as profit when products are sold. Note that that's, even that connection is problematic. Marx thought that the gigantic increase in wealth and population from the 19th century onwards was mainly due to the competitive striving to obtain maximum surplus value from the employment of labor, resulting in an equally gigantic increase of productivity and capital resources, to the extent that increasingly the economic surplus is convertible into money and expressed in money. The amassment of wealth is possible on a larger and larger scale. See capital accumulation and surplus product. The concept is closely connected to producer surplus. So you can see that there's a kind of language problem that is kind of built into this. And, depending on your ability to look at it more literally or more figuratively, as we've been doing, playing with the problems that are partially terminological, but also they're, semantic issues that play themselves out problematically in practice. However, surplus value may be viewed in five ways: as a component of the new value product, which Marx himself defines as equal to the sum of labor costs in respect of capitalistically productive labor, that is variable capital and surplus value. So you're adding up a variety of things, some of which are not necessarily identical and perhaps are spaced out in terms of what happens at what moment in production. In production, he argues, the workers produce a value equal to their wages plus an additional value, that is the surplus value. Now, all this relates to what we're going to get to next in the next chapter of the new translation of Capital, Volume 1. They also transfer part of the value of fixed assets and materials to the new product equal to economic depreciation, that is the consumption of fixed capital, and intermediate goods used up, that is constant capital inputs. So there's a bunch of stuff going on here that Marx attends to, but often doesn't account for it relative to the big question of surplus value. Hence all of that, all the writing and rewriting and the manuscripts and the argument about whether there's a volume 4 and blah, blah, blah. Labor costs and surplus value are the monetary valuations of what Marx calls the necessary product and the surplus product, or the paid labor and the unpaid labor. Now, this paid and unpaid labor is problematic for a whole variety of reasons. Much knowledge labor, intellectual products are, for some people, are seen as kind of unpaid. Making art could be seen as an unpaid labor. Not that those who are artists see it that way, but these are problematic issues. Surplus value can also be viewed as a flow of net income appropriated by the owners of capital in virtue of asset ownership, comprising distributed personal income and undistributed business income. In the whole economy, this will include both income directly from production and property income. So you can see that other things here, property income from rent, for example, the surplus value is a little more complicated. Surplus value can be viewed as the source of society's accumulation fund or investment fund. Part of it is reinvested, but part is appropriated as personal income and used for consumptive purposes by the owners of capital assets. See capital accumulation. In exceptional circumstances, part of it may also be hoarded in some way. In this context, surplus value can also be measured as the increase in the value of the stock of capital assets through an accounting period prior to distribution. So there, we're getting down to another way in which we could get some sort of a fine-grained, some granularity in terms of describing what surplus value would be. Surplus value can be viewed as a social relation of production, which is what we've seen it kind of described as so far in Marx's Capital Volume 1, or as the monetary valuation of surplus labor, a sort of, and this is why I've gotten obsessed with the indexicality issue, a sort of index of the balance of power between social classes or nations in the process of division of the social product. Finally, surplus value can, in a developed capitalist economy, be viewed also as an indicator of the level of social productivity that has been reached by the working population, i.e., the net amount of value it can produce with its labor in excess of its own consumption requirements. So all of these things can be kind of integrated into a theory of surplus value. The question at an empirical level is, how is you going to measure this? Are you going to measure labor relative to labor power? And if so, um, what kind of labor power are we looking at? A certain degree of expectation, um, and this, excluding, of course, the issue of fixed capital or constant capital. So, there's all kinds of stuff going on here that you need to sort of work out. Now, I asked Gemini because I've been still trying to figure this out, and I continue to sort of work on this problem because partially because Gemini sort of tries to deal with it in interesting ways, but I don't take it for granted simply because Gemini always gets thrown off, I think, by certain subgroups in language. So if you mention surplus value, it has a kind of responsive liberal nature to say, well, Marx sort of believes this, but it doesn't quite apply. And you always get that kind of front end framing on it, which is amusing. I mean, Gemini tries to be idiomatically or colloquial or whatever in its response. So some accounting concepts can be seen as related to the underlying idea of surplus value. That is, and these two ideas are actually very good because they are, of course, addressed by Marx. Or profitability ratios are discussed by Marx. A return on investment is not mentioned by Marx, but you can see that there is a little bit of an intersection of this activity. Metrics like gross profit margin, operating profit margin, and net profit margin measure a company's profitability. These ratios can be seen as reflecting the extent to which a company generates surplus beyond its costs. So you get a little bit of detail there. Now, return on investment, ROI, this is a big deal because it is, in some ways, ways in which you can, a method by which you can measure, and because it also relates to time and a bunch of other things, um, a way in which you can get back into the idea of a surplus. This metric, return on investment, measures the profitability of an investment relative to its cost. See, it can get kind of there. It can be seen as reflecting the surplus generated by an investment. Now, of course, investment has, of course, its own problematic tangible and intangible elements. And of course, Gemini sucks up to one saying, you're right to point out the limitations of directly applying Marx's surplus value to modern accounting. Here's a slightly different approach to how cost accounting can offer insights related to the concept of surplus value, even if not directly measuring it. At some moment, I'm sure that Gemini will have a conversation with me about this, and we'll see it get a little bit more stupid. But it's identifying value drivers, that is cost volume profit analysis, CVP. This accounting technique helps businesses understand how changes in volume, that is the volume of production or the volume of sales, affect costs and profits. It helps identify key cost drivers and their impact on profitability. So one would assume that if you're using a CVP analysis, that you can actually aggregate some elements that would actually be surplus. It's something like surplus, whatever that means. This relates to Marx's idea that labor is the source of value. By analyzing how changes in labor input, that is direct labor or indirect labor, which automatically makes it all fuzzy about paid and unpaid, impact costs and profits, we can gain insights into the relationship between labor and value creation. And another concept, and this goes back to when I used to want to be a bureaucrat, about activity-based costing. And of course, whenever I mention that in a job interview, eyes go glaze over. But anyway, ABC, that is activity-based costing, goes beyond traditional cost accounting by identifying and tracking the costs associated with specific activities that drive costs. This provides a more nuanced understanding of how different activities contribute to the overall cost structure and, by extension, to the generation of surplus profit. And measuring efficiency with two sub ideas, among others, productivity ratios, cost accounting metrics like labor productivity, that is output per labor hour, can help measure how efficiently labor is being utilized. This can provide insights into the potential for increasing output and potentially the generation of greater quote unquote surplus. Waste reduction. Cost accounting methods can help identify and quantify waste in the production process, e.g., for example, general waste, idle time. Reducing waste can increase efficiency and potentially contribute to higher profits, which could be seen as a form of surplus generation. So you can see that there are some categories that would help one identify certain types of relations, but noting that they're important considerations. Modern cost accounting primarily focuses on improving business efficiency and profitability, not on analyzing the social and economic implications of profit generation, as Marx did. You see, the point here is, of course, that ideologically, the Gemini makes a separation between the more subjective implications of profit generation and accounting, which is seen to be more objective, whatever that means. Limitations. Cost accounting methods have limitations. Of course, they may not fully capture the social and environmental costs associated with production, which are crucial aspects of Marx's analysis of surplus value. And note, of course, that I just because I'm amused by it, ask further questions on the environmental costs issue. While modern cost accounting doesn't directly measure surplus value in a Marxist sense, it provides tools and insights into the relationship between cost, production, and profitability. By analyzing cost drivers, measuring efficiency, and identifying areas for improvement, businesses can optimize their operations and potentially increase their profitability. However, it's crucial to acknowledge the limitations of cost accounting in fully capturing the social and economic implications of profit generation. So that's Gemini's take on it, with, of course, giving a little introduction, trying to suck up to the reader, and then, of course, providing a kind of summary, which is always the amusing thing about how AI operates. Anyway, the core of my yammering today will be on an Amida-based BAIS article on Marx's concept of surplus value. The project helps us to understand what is surplus value, the concept of surplus value according to Karl Marx, and to know about the different concepts used by Marx in his theory of surplus value. It concludes with the practical application of the theory. Now, the point here is this is a 2012 document, and it has other issues, but it at least spells out some of the issues used when we kind of tackle the idea of surplus value. The importance of surplus value, of course, it is the kind of the big enchilada at the kind of the end of Marx's life, from the point of view that there's so much more to do, and yet so much in between that still didn't get filled out by Engels. So we just need to keep working at it. And of course, some people who are overly invested in the theory of surplus value, because the theory of surplus value is organized in a certain way by certain people, you got to go to Kautsky and a bunch of other people, it can tend to frame the analysis and create some ideological problems, which it really shouldn't. But let's just proceed here and take a look at Bayes's analysis, or Bayes' analysis. Surplus value is the social product which is over and above what is required for the producers to live. The measure of labor is labor time, so surplus value is the accumulated product of the unpaid labor time of the producers. In bourgeois society, a surplus value is acquired by the capitalist in the form of profit. The capitalist owns the means of production as private property, so the workers have no choice but to sell their labor power to the capitalist to live. The capitalist then owns not only the means of production and the workers' labor power, which is brought to use in production, but the product, that is, the thing at the end as well. After paying wages, the capitalist then becomes the owner of the surplus value over and above the value of the workers' labor power. And it is this formation of the property relations of the surplus value, I think, is the thing that we ultimately become interested in because of its manipulation, its use as exchange value, and its use value in a much larger context. And always it is about a question of scale. Um, as an economic theory, surplus value is used by the German philosopher and economist Karl Marx to criticize capitalist value economic systems. Surplus value is the difference between a worker's wage and the price of a good or service produced by that worker. This theory is based on the fact that workers provide value through the labor used to produce goods and services. Surplus value does not relate to the actual value of a physical economic resource or good. That's actually the key element here. That, and particularly the question of service provisions, particularly creative service, but that's a different question. This added value is realized through the labor needed to produce the resource or good, which increases the value of the item above its original cost. Marx believed that individual workers and their productivity is what really determine the value of consumer goods or services. It is a concept used famously by Karl Marx in his critique of political economy, although he himself, he did not invent the concept. It refers roughly to that part of the new value created by production, which is claimed by enterprises as generic gross profit. Marx used the labor theory of value primarily as a tool to develop the concepts of surplus. Surplus value is the central point of Marx's theory of surplus value. Now, surplus value, according to Karl Marx, Marx's analysis of surplus value centers on the distinction between labor and labor power. Worker sells labor power and is paid the value of his labor power. What the capitalist gets from the worker is value creating labor. That is, a type of labor that creates value. If workers were paid for their labor, for the value that they create, they would either be paid in full, leaving no surplus value, or they would be paid less than the value created, which would apparently be a violation of the principle that value is exchanged for value. Either way, it would not be possible to explain capitalism in terms of the exchange of equal values. That just, God forbid. Marx believes that the price of the commodity is to be determined according to labor invested in it. He held that the basis of wealth is labor. The laborers produce wealth with their labor, but the capitalist does not give them their share of profit. The capitalists are in a position to establish big industries, whereas the laborers cannot establish their industries. They're compelled to sell their labor and get employment in the factories established by the capitalists. The capitalists sell the finished goods at a high rate and give meager wages to the laborers. The difference between the cost of the finished goods and their sale price is called profit. This process of earning profit is called the theory of surplus value, according to Marx. Marx held the view that this profit should go to the laborers and not to the capitalists, because labor is the basis for production of all kinds of wealth, and capitalists don't contribute anything. His theory of surplus revealed the mystery of profit of capitalists. Marx argues its ultimate source is unpaid surplus labor performed by the worker for the capitalist, and that the surplus value is the primary basis for capital accumulation. According to Marx, capitalism is essentially the economy of exchanging goods. In this sense, also labor is a product exchanged under the laws of markets, the labor market, for example. Marx's broad conceptualization of production is being divided into two parts. A, the cost of production, which was the labor time spent on producing the good, and B, the surplus value, which was the difference between the good's price and its cost of production. Marx's discussion of value contains an objective part that puts certain aspects of the economy into perspective, but it also explicitly includes an element of shudder ideology. Stripped of ideological overtones, Marx's message is simply that any economy will produce more goods and services than are needed to pay all the real social costs of production, thus subtracting from total yearly output in the United States, all the real costs that must be paid to produce that output would yield a residual, which could be called surplus value. These real costs would include both labor costs and capital costs. Marx's surplus value is thus similar to the physiocrat's concept of net product. How surpluses are divided up is a complicated question that involves issues of philosophy and legal structure. Well, that the fact that they are doesn't, that they're still there. Let's put it that way. And in fact, they're ever more important. At the time that Marx wrote, these issues were very much on people's minds. The Industrial Revolution had brought about large increases in the yearly surplus value created in the world. Marx raised a legitimate question: what is an equitable way to distribute or redistribute this socially produced surplus among participants in the society? But Marx was not content merely to raise this issue, nor was he content to suggest that in his time the cutting of the social pie was inequitable, unjust, and unfair. Marx went beyond this and claimed with scientific objectivity that the surplus created by labor was taken from it because of its lack of ownership of the means of production. See, this is about property again. It is this claim of scientific objectivity that has not stood the test of time and that has led to the careful reexamination of Marx's theory of value. Now, the claim of scientific objectivity is its own whole deal. Whether Marxism is or isn't a science, declaring it a science doesn't necessarily make it a science, et cetera, et cetera. But that's for another yakking. The concepts of surplus and exploitation are still used often in discussions and in the popular press. For example, workers in developing countries are often described as being exploited by global companies because they are paid lower wages than U.S. workers. Similarly, large profits are considered a surplus that is taken from workers. Marx used the terms surplus and exploitation in a pejorative sense. He strongly believed that the income distribution at the time was unfair and that the institutions that led to this unfairness deserved to be called exploitative. Most modern economists see such judgments as going beyond the role of economists as economists. They try to separate normative judgments from positive analysis. And that is, of course, the break or difference between so-called sort of classical economy or orthodox economy and sort of heterodox economists. But even in terms of normative judgments, they question the value of the exploitation concept. They see human nature as generally exploitative and see the market as based on the concept of mutual exploitation. Abba Lerner summarized this view nicely. In capitalism, man exploits man. In socialism, it's the other way around. Ha! The problem of explaining the source of surplus value is expressed by Friedrich Engels as follows, quote, whence comes this surplus value? It cannot come either from the buyer buying commodities under their value or from the seller selling them above their value. For in both cases, the gains and the losses of each individual cancel each other, as each individual is in turn buyer and seller. Nor can it come from cheating, for though cheating can enrich one person at the expense of another, it cannot increase the total sum possessed by both, and therefore cannot augment the sum of the values in circulation. This problem must be solved, and it must be solved in a purely economic way, excluding all cheating and the intervention of any force. The problem being, how is it possible constantly to sell dearer than one is bought, even on the hypothesis that equal values are exchanged for equal values? Marx himself also put the question as follows, quote, if the exchange value of a product equals the labor time contained in the product, then the exchange value of a working day is equal to the product it yields. In other words, wages must be equal to the product of labor. But in fact, the opposite is true. Ergo, this objection amounts to the problem. How does production on the basis of exchange value solely determined by labor time lead to the result that the exchange value of labor is less than the exchange value of its product? Now, Marx gave his solution for this problem. His suggestion was to distinguish between labor time worked and labor power. A worker who is sufficiently productive can produce an output value greater than what it costs to hire him. Although his wage seems to be based on hours worked in an economic sense, this wage does not reflect the full value of what the worker produces. Effectively, it's not labor which the worker sells, but his capacity to work. For an example, well, suppose a worker who's hired for an hour and is paid, 50 Rs, rubles. Once in the capitalist employ, the capitalist can have him operate a boot-making machine using which the worker produces 50 rubles worth of work every 15 minutes. Every hour, the capitalist receives 200 rubles worth of work and only pays the worker 50 rubles, capturing the remaining 150 rubles, which after reduction of costs, the leather, depreciation of the machine, etc., leaves a remaining surplus value or profit. Now, the worker cannot capture this benefit directly because there's no claim to the means of production, that is, the boot-making machine, or to its products, and his capacity to bargain over wages is restricted by laws and the supply or demand for wage labor. Hence, the rise of trade unions, which aim to create a more favorable bargaining position through collective action by workers. So that's one way of looking at it. Let's take a look at a more, well, what the author base defines as surplus value. Total surplus value in an economy, Marx refers to the mass or volume of surplus value, is basically equal to the sum of net distributed and undistributed profit, net interest, net rents, net tax on production, and various net receipts associated with royalties, licensing, leasing, certain honoraria, etc. The way generic profit income is grossed and netted in social accounting may differ somewhat from the way an individual business does that. And of course, I made that comment above when we started today. According to Marx, Marx believed that the price of a commodity is to be determined according to the labor invested in it. He held that the basis of wealth is labor. The laborers produce wealth with their labor, but the capitalist does not give them their share of profit. The capitalists are in a position to establish big industries, whereas the laborers cannot establish big industries. They're compelled to sell their labor and get employment in the factories established by those capitalists. The capitalists sell the finished goods at a high rate and give insufficient wages to the laborers. The difference between the cost of the finished goods and their sale price is called profit. This process of earning profit is called the theory of surplus value. Marx held the view that this profit should go to the laborer and not to the capitalist because labor is the basis for production of all types of wealth. Marx's own discussion focuses mainly on profit, interest, and rent, largely ignoring taxation and royalty-type fees, which were proportionally very small components of the national income when he lived. Now, this is obviously very different now. Marx himself considered his theory of surplus value his most important contribution to the progress of economic analysis, and this is Marx in a letter of Engels of 24 August 1867. It is through this theory that the wide scope of his sociological and historical thought enables him simultaneously to place the capitalist mode of production in his historical context and to find the root of its inner economic contradictions and its laws of motion in the specific relations of production on which it is based. Marx's theory of classes is based on the recognition that in each class society, part of society, that is the ruling class appropriates a social surplus product. But that surplus product can take three essentially different forms or a combination of them. It can take the form of straightforward unpaid surplus labor, as in the slave mode of production, early feudalism or some sectors of the Asiatic mode of production, that is unpaid corvée labor for the empire. This is, indentured or, labor pressed into service. It's not necessarily slavery in that sense. It can take the form of goods appropriated by the ruling class in the form of use values, pure and simple, that is the products of surplus labor, as under feudalism, when feudal rent is paid in a certain amount of produce, that is produce rent. This is the terms under which you can get your little place on the manor. Or in more modern remnants, such as sharecropping, which is another version of that, although it's nearly identical, but is truly the way in which slavery was sort of extended in a variety of ways as a quasi-slavery. And it can take a money form, like money rent, in the final phases of feudalism and capitalist profits. Surplus value is essentially just that. the money form of the social surplus product, or what amounts to the same, that is, the money product of surplus labor. It has therefore a common root with all other forms of surplus product, unpaid labor. And this means that Marx's theory of surplus value is basically a deduction or residual theory of the work of the ruling class's income, which makes it, this is techno-feudalism. The whole social product, that is the net national income, is produced in the course of the process of production. Exactly, it's the whole crop is harvested by the peasants. What happens on the market or through appropriation of the produce is a distribution or redistribution of what has already been created. The surplus product, and therefore also its money form, surplus value, is the residual of that new net social product income, which remains after the producing classes have received their compensation under capitalism, their wages. This deduction theory of the ruling class's income is thus ipso facto an exploitation theory, as mentioned above. Now, not in the ethical sense of the word, although Marx and Engels obviously manifested a lot of understandable moral indignation at the fate of all the exploited throughout history, and especially at the fate of the modern proletariat, but in the economic one. This is, it's not this ethical thing that shows that, there's a whole history of this, but it is about the more simple economic relation. The income of the ruling classes can always be reduced in the final analysis to the product of unpaid labor. That is the heart of Marx's theory of exploitation. According to Marx's theory of exploitation, living labor at an adequate level of productivity is able to create and conserve more value than it costs the employer to buy, which is exactly the economic reason why the employer buys it. That is to preserve and augment the value of the capital at his command. Thus, the surplus labor is unpaid labor appropriated by employers in the form of work time and outputs, whether it's relative or absolute, on the basis that employers own and supply the means of production worked with. The commercial function of labor is only to conserve their value, add value to them, and transfer value. Marx finds himself with the economic dilemma, capitalism and its systematic ability to maintain a profit. With this quandary, Marx finds himself with the conclusion that a profit produced by a capitalist system intrinsically relies upon an exploitative relationship between that of the capitalist and the worker. Quote, with the increasing exploitation of labor, the profit of the capitalist also accumulates. The theory of surplus value refers to the quantity of value produced by the worker beyond necessary time. The price of any commodity is determined by the amount of labor it takes to produce it. The increasing exploitation leads to the surplus wealth accumulated by the capitalists, thereby dividing society into rich and poor. Now, of course, one needs to explain, Marx's labor theory of value, and here it is. The labor theory of value is a theory in the science of political economy to explain how the working class are exploited under capitalism and how capitalist society works. The labor theory of value is central to an understanding of the economics of capitalism because capitalism is a commodity production par excellence, and it is the stage in the development of human society characterized by class monopoly of the means of production, with wage labor and commodity production, because there are, markets for consumption, et cetera, et cetera. According to Marx's labor theory of value, human labor is the only source of net new economic value, but it's also indispensable for the conservation and transfer of economic value, that is, the maintenance and redistribution of capital assets. Asset revaluations, according to this theory, only redistribute claims to product value, which has already been created previously. Absolute and relative surplus value. According to Marx, the unnecessary labor time in which the worker recoups for the capitalist the value which the capitalist has not paid wages for creates surplus value. The rate of surplus value can be increased by lengthening the working days so that more surplus labor is extracted on top of a given amount of necessary labor. Surplus value can be equally increased within the limits of a given working day if necessary labor time can be reduced. That is, if the value of labor power falls. Now, according to Marx, absolute surplus value is obtained by increasing the amount of time worked per worker in an accounting period. Marx talks mainly about the length of the working day or week, 12 hours as opposed to 8 or 10. But in modern times, the concern is about the number of hours worked per year. And relative surplus value is obtained mainly by reducing wages. This can only go to a certain point, because if wages fall below the ability of workers to purchase their means of subsistence, they'll be unable to reproduce themselves, and the capitalists will not be able to find sufficient labor power. By reducing the cost of wage goods by various means so that the wage increases can be curbed by increasing the productivity and intensity of labor generally through mechanization and rationalization, yielding a bigger output per hour worked. Surplus value that derives from a reduction in necessary labor time is called relative surplus value, distinguished from absolute surplus value, which results from a lengthening of the working day. It is, however, necessary to understand that it's not possible to identify one part of surplus value as relative and another part as absolute without a starting point. That is, you have to start making comparisons between what was being manipulated as relative surplus value, or achieving relative surplus value, versus absolute surplus value. So you have to go through several periods of trying to measure this stuff. Different concept used by Marx in the theory of surplus value. First, labor. Labor, according to P. Savchenko, has always been a domain of exchange between man and nature. Objectively, to man's vital activity, labor is his eternal companion and most important factor in the evolution of world civilization. The instrument and objects of labor essential to manufacturing the things that man needs are material elements of the labor process. In their totality, they constitute the means of production. The excess value created by wage workers over and above the value of their labor power is referred to as surplus value. It's appropriated by the capitalist without remuneration. That explains why surplus value is the goal of capitalist production from the capitalist point of view, only that labor is productive, which produces surplus value and increases the capitalist's capital. The concept of value. To understand the importance of value and the concept of surplus value, it's important to brief about Marx's theory of value. According to this theory, the main postulates emphasized by Karl Marx are: commodity production is the outcome of a specific division of labor. Only such products can become commodities with regard to each other as result from different kinds of labor, each kind being carried on independently and for the account of private individuals. The value of commodities expresses what private labors have in common. It is a socially necessary quantity of labor. Exchange relations are the manifestation of the social character of value. If we bear in mind that the value of commodities is a purely social reality, it follows that, as a matter of course, that value can only manifest itself in the social relation of commodity to commodity. Valorization. Valorization thus specifically describes the increase in the value of capital assets through the application of living, value-forming labor in production. The valorization of capital is a concept created by Karl Marx in his critique of political economy. In modern translations of Marx's economic writings, the term valorization is preferred because it is recognized that it denotes a highly specific economic concept. It refers both to the process whereby a capital value is conferred or bestowed on something, and to the increase in the value of a capital asset. A value creation process which goes beyond the point at which the worker has just created the equivalent of the value of his own labor power and begins to increase the value of capital is a valorization process, not just a value creation process. That's why valorization is important, because it's a way in which you can characterize the production of such surplus value. Rates of surplus value. The rate of surplus value is also called a percentage of surplus value and degree of exploitation as well. When the workers get down to work, they have to perform for some time work that is equivalent to the value of wages. This portion of the work is one that has to be performed for their own sake. Workers have to do this portion of work. For laborers, this is the portion of necessary labor. After the completion of work that is equivalent to the value of wages, whatever work that is performed thenceforth, the whole of it will not be for the sake of the workers, but for the sake of the capitalists, which means after getting down to work every day, workers perform necessary labor for some time and surplus labor for some other time. Neither the capitalists nor the workers know that the work done daily thus consists of these two portions. If the working day is 12 hours, it may have 6 hours of necessary labor, 6 hours of surplus labor, or there may be 4 hours of necessary labor and 8 hours of surplus labor. These two portions thus might be of any portion. It is the rate of surplus value that expresses the ratios of the two portions of labor in a working day. By means of this rate, one can know how much work the workers have done for themselves and how much for the exploiters. This rate of surplus measures exploitation just as a thermometer measures heat. It reveals the degree of exploitation. The rate of surplus value can therefore be called as a degree of exploitation. Surplus value will be known only if the expenditure spent initially on the commodity and the value at which the commodity is sold are known. Thus, the rate of surplus value will be known if the proportions of wages and surplus value are seen. The rate of surplus value is represented by the following formula. That is, surplus value that is divided at SV equals surplus value equals surplus labor. Disapproval of the Marxian concept of surplus value. The most fundamental criticism of Marxist theory of value is offered by Austrian economics, which holds that the value is purely subjective. It cannot be derived from labor, surplus, or otherwise. The labor itself can be productive, resulting in creation of goods which are desired by other people, or destructive, merely wasting resources on creation of goods nobody wants. This phenomenon was quite evident in socialist economies. Thus, we can say whether something has value or not only by observing voluntary exchange between people. When such exchange is prevented, there is no way to tell if the labor is creative or destructive, and so it is impossible to direct the efforts towards creation of value. This impossibility of economic calculation was famously proposed by Ludwig von Mises as the reason for imminent failure of socialist economies, in stark contrast to predictions of Marxist theory. There are two major issues with this approach, among others. First, Marxist theory never made any predictions of the managing and functioning of the socialist economy. He didn't. The socialist calculation debate was largely carried out by neoclassical sympathizers attempting to apply concepts that function within the framework of neoclassical economics to the maximization of production and planned economic development. Its failure, the Soviets, shows the failure within the neoclassical paradigms more than anything else. Second, and more fundamentally, this argument misses or ignores the fact that Marx did not attempt to explain value from the labor time of individual producers in isolation, but from socially necessary labor time that becomes normalized as capitalist production expands and includes the mass of producers in a social web of production. Value begins to dominate exchange to a greater extent as production becomes social, or the division of labor that capitalist production encourages expands. Some economic historians argue that Marx did not discover the concept of surplus value because other political economists had already discovered it first. There's some truth in this, but as against that, Marx only claimed that he had theoretically refined and systematized existing notions of added value, removing inconsistencies and apologistic theories. His theoretical presentation is far superior, though, to that of his contemporaries, as economic historians acknowledge. A substantive foundational criticism of Marx's concept of the surplus product and surplus value was made by Harry Pearson in the 1950s in his essay, The Economy Has No Surplus. Another modern, more sophisticated critique is by Helen Boss. An alternative criticism is by Steve Keen, who argues that the economy does have a surplus, but that it can arise from numerous different sources. Specifically, he claims that mathematics and Marx's philosophy confirm that surplus value, and hence profit, can be generated from any input to production. Thus, Marx's view that economic value is a human attribution or comparison, and that only human labor can conserve, transfer, and create value is rejected. That's an important kind of issue about whether the abstraction holds, and it does. Some issues concerning surplus value and its rate. If an example is made of cloth manufacturing where the constant value 180 and the variable value is 20, there are still fixed means of 400 value in the workplace. The rate of surplus value has to do with either the 80 constant or the fixed mean of the workplace. As wages alone give the surplus value, the relations of the two factors alone continue the rate of surplus value. And so there's a bunch of issues about surplus value. Surplus value and the rate of surplus value are not the same. Surplus value means the mass, which is excess, uh, excessive, more excess than the capital itself. The rate of surplus value means the relationship between the ratios of necessary labor and surplus labor. The formula to know surplus value is commodity value minus capital. The symbol of surplus value is S. The symbol of wages is V. Therefore, the formula of rate of surplus value is S over V. Symbol for the rate of surplus value is SI. Conclusion. Surplus value is critical to the expansion of capital. The specific economic form in which unpaid surplus labor is pumped out of direct producers determines the relationship of rulers and ruled, as it grows directly out of production itself and in turn reacts upon it as a determining element. Upon this, however, is founded the entire formation of the economic community which grows up out of the production relations themselves, thereby simultaneously its specific political form. It is always the direct relationship by the owners of the conditions of production to the direct producers, a relation in which naturally corresponding to a definite stage of the methods of labor and thereby social productivity, which reveals the innermost secret, the hidden basis of the entire social structure, and with it the political form of the relation of sovereignty and dependence, in short, the corresponding specific form of the state. That is, the state helps to manage some of these relations. And in fact, it is the assurance or whatever, the reification of contract relations between the proletariat and the capitalists that is what this is about. This does not prevent the same economic basis, the same from the standpoint of its main conditions, due to innumerable different empirical circumstances, natural environment, racial relations, external historical influence, etc., from showing infinite variations and gradations in appearance, which can be ascertained only by analysis of the empirically given circumstances. The overall conclusion after going through the Marx concept of surplus value is that the theory is relatively important in the support of the laborers, but when it comes to the owners, this theory has its own weak points that does not completely support or is against the system of capitalism. So it is problematic in that particular context. And what I tried to do, of course, is ask certain types of questions. That is, in political economy, measuring the difference in production and consumption can be approached in several ways, each offering unique insights. So there's value added, input-output analysis, labor value, and ecological footprint, all of which, and social accounting matrix as well, and indices of sustainable welfare. So those things like time use surveys, all of these methods can provide a more nuanced understanding of the relationships between production and consumption, moving beyond simple quantitative measures to incorporate qualitative, social, and environmental dimensions, which is kind of what Marx wanted to do. This allows for a comprehensive analysis of economic systems and their impact on society and the environment. And further on, I've tried to ask certain questions, Gemini questions, about what is a capital asset, and it can be defined in a variety of tangible and intangible ways. And it is those definitions on which I would say that a closer analysis of surplus value should be placed. So that's kind of what I have to yak on, and I've achieved the ending of my time. I've ended exactly on time. And there are some questions. Yes. Anna asks, so you mean all those Amazon warehouse workers and Uber drivers and musicians on Spotify should get their own fair share of the profit? But if owners define the salary for the inner circle, surplus value loses its meaning. There is no surplus value we could spend on business dinners and fancy cars and paying other expenses for those who really deserve it. Indeed. And in fact, it's unfortunate that politics and the three martini lunch are somehow entangled with each other. So that would be my little comment on that. Let me now end the share and move to stop the live stream so we